Hello everyone, welcome to Accounting 210. In this video, I want to talk about the final exam review. Just to give you some idea, you can see I have three different things. I will use my handwritten one, but maybe do some notes on the copied one, and then I go the packet with the textbook. So the general idea for the final exam is that the problem will from the new chapters, chapter 10, 11, 12, and 14. But you may still have, you will still have some multiple choice from the exam old chapters. I think 80–90% will be similar with the question from the first two midterm exams. So my suggestion is, okay, here is my suggestion is, you don't really have a lot of time to prepare for the final exam. So I would say first, work really hard on those new chapters. One more time, chapter 10, 11, 12, 14, work really hard on those one. Because I think the new chapters will be around 60–70%. And then really review your first and second exam. Make sure you know everything there, at least try to know everything there. That's the minimum requirement. And then read this final review kind of. If you have extra time or if you want to get A or B, let's just put that way, check your notes, kind of for old chapters, especially the important thing. Okay, so let's start. Okay, chapter 1, nothing really much. I don't think I will test you, so don't worry about that one. That really helps, right? So you don't have that chapter. Chapter 2 is a good chapter, talking about many concepts. I think now if you look at chapter 2, you will feel much better. 3 types of company, basically about the inventory. So I put the textbook page 50. Sorry about that, but I want to give you some idea why I put the page and kind of tells you how do you read your textbook for the final review part. You have to know there are 3 types of companies. Try to show you. So you have the service, merchandise, and the manufacturing. You have to know the main difference is about the inventory, right? We said service, there is no inventory. Merchandise, they have the one, kind of they buy from manufacturing. And the manufacturing has 3 types of this inventory. Merchandise also actually has 3. We talk about that. It's the freight-in tax, or customers, or the product. So you still have 3. And then manufacture is direct labor, direct sorry, it's raw material, working process, and finished goods. So make sure kind of you get that thing. Then kind of summarize different terminologies of cost. We can organize cost based on its direct or indirect. So if direct, we trace. If indirect, we allocate. We have been talking about allocating the manufacturing overhead. You should know what's the meaning of allocation. And then we talk about, so if I say, hey, what is direct cost, what is indirect cost, you should be able to know what is product cost, what is period cost. Make sure you know those things. What is product cost, what is period cost. I'll put the page number there, give you general idea. I say it's there. So I say, hey, if the CEO's salary, that's the period cost. I said, if it's direct material, that's product cost. Hey, I said, does service company has product cost? There is no product cost. You have to know there is no product cost for service company. And then cost of goods sold in income statement. So how does the cost flow, right? I don't remember which chapter, but I've been talking about that. Let me look at whether it's this page, yes or no. Oh, I think about it's how, yeah, it's kind of this page, right? So make sure you really know the flow of the cost. It's first from the raw material, you add direct labor, and then manufacturing overhead, it became working process, and then became you manufacture, became finished goods, and when you sell it, those are in the balance sheet. When you sell it, it became to cost of goods sold. Okay, so we talk about that. If you produce 100 units, you only sold 80 units. cost of goods sold only based on the 80 units. That's the important part. We have been talking about that. Make sure you know what's the meaning of fixed and variable regarding the total cost and each unit. We said, hey, total units for the fixed one will be constant, but it will decrease when the volume goes up for each allocated for each average fixed cost for the each average unit. For variable, it's different. Variable for each unit is constant, but total will increase if we increase the volume. So those things you should be able to know now after you have been talking about all those chapters in detail. Chapter 3, talking about job costing. Main part is how do we allocate our manufacturing overhead. Remember, that's the part we did the journal entry, and then we did kind of a lot of calculation. First, you need to know how do we get a predetermined manufacturing overhead rate. When we do rate, we use the estimated number. We use total estimated manufacturing overhead cost divided by total estimated amount of the cost allocation base. But when we allocate, so once you get the rate, you just don't look at the estimation. When you do allocation, you use your rate time your actual amount of the cost driver. Okay, let's say, hey, go back to our notes to know what I'm talking about. You use the estimated to get the rate, and then you use the actual to get the allocation. I kind of give you general ideas that there is one journal entry. Make sure you kind of got there on page 134, 35. When we allocate our manufacturing overhead, right? This is important. Is when the actual happens, we just accumulate there, having our manufacturing overhead, debit our manufacturing overhead. And when we allocate our manufacturing overhead to each job, then we increase our work in process. Debit our work in process. We credit our manufacturing overhead because you already allocated to this specific job. Okay, so make sure how much you should allocate is your rate times your actual cost driver. Another thing we have been talking about is how to define is under allocation or over allocation. It's always, I know you don't like this, but you always put your actual on the left side. You put your allocation. It's not estimation. Once you get the rate, you forget estimation. You put your actual and then your allocation, no estimation, right? And then we want our actual to be 0. So let's just put a number. Say your actual is 100,000. Your allocation is only 90,000. So you under allocated. You want your actual to be 0. So you have to credit 10,000 on allocation. You have to increase cost of goods sold by 10,000. Manufacturing overhead allocation credit based on 10,000. So your actual 100,000 allocation is 90,000 plus that extra 10,000. You zero out your actual manufacturing overhead. I hope you still remember that part. Chapter 4, talking about ABC costing. We first actually talk about department instead of the whole plant rate, but we talk about departmental rate, a similar idea, but instead of using the whole plant, we use each department. But then we said, hey, the ABC costing is more accurate, so we use each activity, right? You set up your machine, you do your quality checking, kind of those activity. I think the one thing you need to know is the 4 categories of the activity cost. What is unit level? What is batch level? What is the other level? I don't remember. 190. What are the other 2 levels? Make sure you got some idea. If it's multiple choice, you know. Unit level is we said like the packing, inspecting. Batch level is when you machine set up Product level is the lease payment on equipment used solely for that particular product. Facility level, kind of rent, insurance, those things. Then based on each active, we allocate our manufacturing overhead. Okay, chapter 6. Okay, so after that one, that's the first exam. That's the first exam. Second exam covering these 4 chapters. Chapter 6 talk about cost behavior. I think easier than allocation. So first, one more time, we talk about variable cost and fixed cost in detail. So you really should get the idea what is that, what is what. And then we talk about high and low method. So we said it's high and low based on the cost driver, based on, machine hours, based on the visitors, it's not really based on Y, it's based on X. So how do we get our cost behavior? You have a question in the exam too, I still remember. Make sure you know high and low method. So you get your slope based on this formula. Total cost equals to variable cost plus your fixed cost. I put page number 325. Make sure you read that one, high and low method. Then chapter 7, I think most students like this one, CVP analysis, cost volume profit analysis. I don't want to say too much. I think once you understood the idea, you just read your notes, you should be able to recall the material. Make sure you know what's the meaning of a contribution margin in dollar amount or in percentage. If I say, hey, contribution margin is 40%, that means your variable cost is 60%. So your revenue minus variable cost gives you contribution margin minus all the fixed cost gives you operating income. That's the basic general idea for our CVP analysis. A break-even point, you should know this one, you should have to know this one. So it's your fixed cost. If there is any target operating income, you put target operating income. If it's just break-even, it's 0, right? And then we divide it by contribution margin for each unit. We talk about change of variables. So I said, hey, if I increase the fixed cost, then break-even point will increase. You have to sell more units to break even. If I change the contribution margin, what will happen? If I change the sales price, what will happen? If I change the variable cost, what will happen to our break-even point? Talk about that. I hope you still remember. I highlighted a mix of product. Remember this one? I talk about if you sell small coffee, big coffee, something like that. How do we get a bundle product? You sell 3 textbooks with 2 softwares. How do you get that thing? So make sure you know that one. I think I may put one multiple choice there. Just give you some idea. Since I already told you, I may put. Hopefully you will be ready, prepared for that question. And the margin of safety, nothing really much to say. So if your current sale is $200,000 and break-even point is $170,000, so your margin of safety will be $30,000. We want the margin to be larger, right? Larger means you are safer. Margin of safety. Larger margin means you are safer. Chapter 8, talking about relevant cost for different situations. You have to make the decision. One very important thing is what's the meaning of relevant. We look at the relevant, we only look at relevant information, we also call incremental, different, those things. It has to happen in the future, and I put and here, and makes difference, right? So there is incremental, there is avoided, etc. Kind of those things. They said about special order, discontinued product mix, make or buy. Talk about opportunity cost there. I'm not going to really read here kind of a special order, right? I said, hey, you normally sell this pen at $10 each, variable cost is $2. And then if I say, hey, can you make a pen just for me, just a one-time special order, it will not affect your fixed cost. I offer you $3. You usually sell at $10, but I just give you $3. but your variable cost, which is relevant cost, is $2. So you should take my order because your incremental revenue, $3, is more than incremental cost, which is $2. So we only look at the relevant information. We only look at the things that are different, incremental. We don't look at the not change. Sometimes most likely it's fixed cost, kind of all the unavoidable fixed cost, that part. Make or buy, we thought about opportunity cost. If you buy this red pen, you can make the green pen and get $2 more, something like that. Do you still remember? I hope you still remember those things. Check your notes and then get some idea for that chapter. I think I like chapter 8. I think it's very important for your daily life too. Okay, now we talk about chapter 9, master budget, and then it's kind of related with the chapter 10, 11, 10, I think chapter 9, 10, 11, they are kind of related, talking about budget, right? Talking about budget. Chapter 9 is the master budget. So you have to kind of go back to the page to get the overall idea. You have the master budget to make the income statement first and then make the balance sheet, right? We do the master budget at the beginning of the year, and then we always start from the sales budget. So I said there are 3 kind of things you want to. I'm not going to test you direct the material, those details. I'm not going to test you that one. If I test you, I think product budget, you have to know you really have to, but you may want to go back there because it's different from the unit you will sell. You go from the sales budget, you do an adjustment, you add the ending inventory, which is 20% of next month sale, and then you subtract the beginning inventory, which is the percentage of your this month sale. Remember that one? And then cash collection budget, I think this is also a good one. You sell things on credit, so you have a December on credit, you have a January on credit, February on credit, March on credit, and then you will collect 10% of your this month credit sales, collect 20% of your last month credit sales, and then collect maybe 60% of 2 months ago credit sales. So those things, remember, you have a question in the second exam, I believe it's the last question in the problem part. So make sure you know that thing. And then also for the adjustment, we said why the cash payment is different from expense, because some non-cash item, depreciation expense and bad debt expense, so you have to adjust those things. Okay, so once you do chapter 9, you should kind of get the idea of chapter 10. We talk about performance evaluation, different things. I think I'm not going to repeat it because those are new chapter, and I make video for each chapter. Decentralization, responsibility center, and then variance. You have to know it's favorable, variance or unfavorable, depending on it will increase or decrease your operating income. And then we said about ROI and RI, which will reach the goal conference. What is the meaning of goal conference? We did this in class. So if you have a project, you expand your building. Before the expansion, what is your ROI? After that, what is ROI? Before that, what is RI? After that, what is RI? We did a test. We found out, hey, RI will reach the goal conference with the department manager and the top level CEO. Remember that one? And then we talk about flexible budget. Flexible budget, use your actual output. So you have your actual always on the left side, you have your budget always on the right side. We have master budget, so it's master budget. Master budget is budgeted output, budgeted price. Actual is actual output and actual price. But your flexible budget is a hybrid, it's in the middle. You use the actual output, but you use your budgeted price. You remember the puzzle we did in class? I think some of you didn't like it. Hopefully you got a better idea now. So this is your flexible budget. This is called actual, this is called flexible budget, this is called master budget. So the difference of these two called flexible budget variance. It can be favorable, it can be unfavorable. The difference of these two called volume variance. It can be favorable, it can be unfavorable. The total difference called the master budget variance. It can be favorable or unfavorable. Make sure you know how do you calculate all the variance, and then make sure you know the relation. So the master budget variance is the sum of flexible budget variance and then volume variance. So flexible budget variance is $3 favorable, volume variance is $5 unfavorable. So master budget variance will be $2 unfavorable, right? And then last thing in chapter 10, I think chapter 10 really talks a lot of things. Chapter 10 also talking balance the scorecard, right? There are 4 perspectives. Make sure you know if I ask you anything I said, how about the defective rate? That will be internal business perspective. Make sure you know what is what there. It's really very easy to test you using the multiple choice. Make sure you know that one. Chapter 11, still talking about the variance, but we focus on the manufacturing cost, right? Directly by direct material and the manufacturing overhead. We separate the flexible budget variance to 2 parts. So we break this variance to 2 parts. We break this variance to 2 parts. Direct material, direct labor, manufacturing overhead, they are all variable costs, and then fixed manufacturing cost is the fixed one. So those 3, they share the same logic. Flexible budget variance, you can break it down to either dollar variance, which is price rate variance, or the quantity variance, which is quantity efficiency variance. I said make sure you know calculation and interpretation. Okay. The thing I wanted to point out is I use actual standard. So the first variable is always the number, is always for the direct material, is always how many pounds you used, is always the number. And then each pound you paid $16, $15. Second item is the price. So it's actual will be actual standard is the middle, and the standard will be the right side. How do you calculate? How do you interpret? So for the other thing, we did this in class actually, is how do you get the standard quantity? How do you get the standard number? So go back to our notes, but general idea is you have to use your actual output of the units times the standard quantity for 1 unit, right? So I said, hey, you produced 30 cases of chips, and based on the standard, each case you need 2 pounds of flour. So your standard quantity will be 30 cases times 2 pounds for 1 case, which gives you 60 pounds. So that is your standard quantity, and then you times the standard price. Hope you still know what I'm talking about. Calculation and interpretation. I said if you have favorable price variance, how do you interpret which one you should promote, kind of. If you have unfavorable quantity variance, which one you should blame. Fixed manufacturing cost is a little bit different because it's actual and the budget there. So you don't have AS, you have the budget. So the difference called budget variance. And then the budget and the standard is called volume variance. I said make sure you know the interpretation. So if you have a favorable fixed manufacturing overhead volume variance, that means your actual output is more than your budget. You thought you will produce 10 cases, you produce 12 cases. So you will have a favorable fixed manufacturing overhead volume variance. Okay, and then chapter 12, I don't want to say too much. We just finished this chapter. I didn't put chapter 14 because I think you just finished the chapter. You should know what, you should still remember everything, right? Chapter 12, capital budget, time value of money. We basically talk about those four methods, payback and ARR. Make sure the ARR is the only one use accounting number. How do you adjust from cash to operating income is you minus the depreciation expense. We talk about NPV, that is your net present value. So you have to discount all the future cash flows to present value. If it's a one time, you use table 1, table A. If it's the annuity, you use table B. And then we also talk about IRR, about each individual investment, the return. You have to get this return by looking at the table. You cannot really calculate. You have to go back to the table. You got the discount factor. You look up, you find the rate. That will be the return. Okay, I think that's basically all I want to say. I know it's kind of dry if I just talk about this each chapter. Just to give you some idea, as I say, check your first 2 exams and then start from there. We do some practice together in class. Let me know if you have any questions. Thank you.